Hi everyone, welcome back to another episode of Providend's Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Providend. Joining with me today is Deputy CEO and Chief Advisory Officer, Evelyn Goh. Hi Evelyn.
Hi Isaac.
Yeah, thanks for joining us today.
Thank you.
So after working tirelessly for 22 years at Providend, you finally took a 4-month sabbatical this year. How was it?
Oh, it's definitely very good. Very thankful, very thankful for to Chris and Moon for allowing me to go for the sabbatical. I mean, it was a very enjoyable break. I mean, I get to do things that I never had time to do. Finally, found some hobbies, so that was nice. Yes, and happy to be back at work.
Yeah, time must have flown by for you.
Yeah, it did.
Glad to have you back. Your absence has been felt and your presence has been missed. I hope you are recharged and ready to continue leading us towards our goals. So today's episode is about resilience through financial crises. As a member of the Providend founding team, you have experienced and managed a wealth of clients through various financial crises over the past 2 decades. From the 9/11 attacks on the day of Providend's founding, the SARS outbreak, the global financial crisis, and recently the COVID-19 pandemic. Which one of these crises do you think was the toughest one?
Well, for the listeners out there who are familiar with the Providend story, you would know that we started shop on September 11, 2001. And because national security then was the key concern, Financial Advisors Act in Singapore was delayed. And we have all left our previous job, no income, but having overheads like rental, staff costs to pay. So that was very tough for us, but really more from the personal financial standpoint and the uncertainty and the worries of when we can officially get our license to practice as a firm. SARS happened in the year 2003. The firm has just started to onboard new clients and collecting assets under advice. I really do not remember that there were major worries over how portfolios are doing, but it's really more about general health, well-being of staff and clients. GFC, the global financial crisis, 2008, that was the scariest and the toughest. It was bad news after bad news. You see large institutions like Bear Stearns, Lehman Brothers collapsed. People lost faith in the global financial system. At one point, markets tumbled close to 40%, and there were a lot of fear, a lot of uncertainty. As a firm, our assets under advice fell from the peak of 258 million in September 2008 to 168 million. So that's like a 90 million drop at the end of 2009. Clients were fearful, so we try our very best to hold them back from bailing out. And we are thankful that we did not see too much redemptions. But our experience through this GFC actually taught us many precious lessons, which caused us to review our investment philosophy and enhance the way we coach our clients. So when COVID-19 happens, we were a lot better prepared and our clients are more assured. And in fact, we have many clients who top up their investments during the market dips and they benefited when the market recovered in 6 months' time. So that was a very good outcome for them.
Thanks for sharing, Evelyn. Hearing you recount all these crises really sends shivers down my spine, especially with all the other factors on top of a declining financial market. On that note, I noticed that when people look back at financial market graphs and charts, some may express regret of not buying when the market was quote-unquote low or sticking with investments that they have sold. What are certain aspects that people tend to disregard or forget when looking back at past market downturns?
I think it's always easier to look back at events and then say, if only. We're all guilty of that. But we tend to forget that we go through a lot of emotions when you're in a crisis. You read the newspapers, you scroll on social media, the headlines are all screaming doom and gloom. You talk to your friends, you talk to your colleagues, or even the Grab driver. Everyone is saying that things are going to be really bad this time. You read about retrenchments, or maybe you do know of people who are retrenched, and you also worry, right? What if it happens to you?
Right.
And then you look at your investment holdings, profits are gone, maybe even in the negative terrain, and you worry that it's a downward path all the way, and you will never be able to recover your hard-earned money. So the fear, the worry can be very real.
That's right. I recall during the COVID-19 pandemic, I was working in an office building at Suntec, which had a TV in the lift that constantly shows financial news. So every morning I saw how markets were falling 5 or even close to 10% a day. I dread to even look at my investment portfolio at that time.
Yeah, I mean, it's scary, right? And our emotions can cause us to make decisions that we may regret later. And behavioral scientists have a name for this. It's called loss aversion, which simply means that the pain that you experience when you lose $1, okay, is so much greater than the joy of gaining $1. And this overwhelming fear of loss can cause investors to behave irrationally and make bad decisions, such as selling out at the worst of times.
Right. So with this understanding of the human psyche, how does Providend's approach to wealth planning help our clients tide through challenging markets?
At Providend, we believe that planning comes before investing. So we need to have a deep understanding of what motivates the client, what are his concerns, what are the life events that he needs cash for, when and how much it is. And given his current available resources, we will then calculate what is the rate of returns he needs for his investments to cater for the life events. So through our very thorough advisory process, clients know why they are investing, and that's really very important, and which will be the anchor for them to stick to their plan. And we know what sort of risk the clients can afford to take, or what we call their ability to take risk, given their current financial health, their level of protection for key life events, such as key life risk, such as premature death, medical crisis or disability, unique family situations, and the time frame they can afford to stay invested. So all this will allow us to recommend portfolios with asset allocation that are suitable for them. And the client will also then have the assurance that even if markets were to crash in the short term, they have the mental time frame to stay invested.
That's right. Understanding your financial health and ensuring that you are protected against key life risks is important, as, for example, an unexpected medical expense were to happen could force you to liquidate your investments during a bad time.
That's right.
This mental time frame prior to investing that you mentioned is also really important, especially when a downturn inevitably comes. I remember a quote from Warren Buffett. It's quite famous. He says, "A rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked." So before the bear market of 2022, we see that everyone was profiting off various kinds of assets. When markets started to fall, we see that people start to really scrutinize their investments, looking for any rationale or reason to justify clinging onto their investments. That's why having a sound and robust investment philosophy from the get-go is key.
Yeah, that's definitely true. During our advisory process, we will actually take time to explain to our clients Providend's investment philosophy, that we actually understand our clients that whatever money that they set for investment is their hard-earned money, and they are investing for important life events, such as the funding of their kids' tertiary education or funding their dream retirement lifestyle. So our investment approach is based on asset allocation, global diversification, and using non-forecasting and index funds. And all this are actually very well supported by research and empirical data to be able to generate sufficient returns for the clients with a high certainty over time. And we think preparing and preempting clients for their investing journey is very important. So we will show them the historical range of returns that their portfolios have gone through, that there could be years of negative returns, so that they are prepared for it mentally, even before they open their investment accounts. And our clients are also assured that funding their accounts are only the beginning of a lifelong journey that Providend has embarked with them. That we will constantly be looking out not only for their wealth plan and their investments, but more importantly, be there to assure, be there to calm them when the challenging market comes.
Right, so Turbulence Management Plan, TMP, is an initiative launched by Providend as part of our service offering to clients. Being the project head of the team that launched this initiative, could you explain to our listeners what this initiative is?
Sure. As we have discussed, cognitively in our head, we may all understand that over long term, markets always go up. In the short term, stock prices will go up and down. Sometimes the swings are very big, and that's why equities actually gave us higher returns compared to us just leaving money in the bank. Emotionally, it can be very, very difficult. Yeah, so at Providend, we recognize that we have a huge role to play to ensure that our clients stay the course, to enjoy the positive investment outcome, that we need to be that voice of calm and reason during a market crisis.
Right. So how did crisis management plan, which is the predecessor of the turbulence management plan, come about?
Well, having experienced a good 10 years of positive returns in the stock market, we felt there is a need to prepare for a market downturn. So in the year 2019, the management developed the crisis management plan, or Singaporeans like acronyms, right? So we call it CMP for short. And CMP is essentially a coordinated plan between different departments to step up on our client outreach when there is a major market dip. Our investment team will prepare the market update, brief our client advisors on what is happening, and then our brand team will broadcast the market update to our clients, and then our client advisors will reach out systematically to the clients under their care. In terms of messaging, the market update is really to provide the backdrop of what happened that caused the market to come down. And this is important because sometimes when we don't know why market come down, we are scared. Okay, so having this knowledge is important. And given that our clients tend to invest for the longer term, we will almost always provide some data and evidence, okay, to show them how their broadly diversified portfolio will still be able to deliver returns over time. And this is at the corporate communications level. When the client advisor reach out to their clients, they will coach them based on their individual wealth plan to assure them, and if need be, review their wealth plan. And just like how our army runs exercises and mobilizations to prepare for war, as a firm, we actually conducted dry runs to ensure that the respective departments know their specific role and the whole machinery runs effectively.
Right, and it didn't take long before we had to activate this CMP, right?
Yeah, because we all know COVID-19 actually hit shortly after. Okay, so early 2020, markets actually came down close to 29% from its peak at one point. So thankfully, we are all fresh from our simulations and our dry runs. So all the teams swing into action. We provide timely communication pieces for clients through our corporate channels. We speak with those clients who are very jittery. Essentially, is to do whatever we can to be that voice of calm and assurance for our clients. And with pandemic lockdowns changing the way businesses are conducted, we have to quickly adapt, and we started hosting webinars to continue our client engagements. And for a period, we were actually conducting one webinar every fortnight. So this coordinated effort actually paid off. There were no panic triggered kind of redemptions, and in fact, many clients top up to their accounts, and that move really paid off when the markets make a roaring comeback 6 months later. So with that positive experience, Providend actually ran simulations every year to ensure we stand ready to be there for our clients, and we call this our open mobilization exercises.
I see that we took a lot of things from the Singapore Armed Forces.
Yes, because my boss loves the army.
Right. So the crisis management plan is now replaced with the turbulence management plan, TMP. So what are some notable differences?
Well, in year 2022, we started a project team to review and to enhance the CMP. We really wanted to use an analogy that clients can easily identify with. So we decided to adopt the air travel analogy. So Isaac, when you take the aeroplane, right, for your holidays, do you expect to encounter turbulence?
Yeah, almost always.
You do, right?
Yeah.
I think for us, we all kind of expect some level of turbulence. But we know it's normal. It's just part and parcel of flying. And to share some nuggets of truth, you'll be very comforted to know that turbulence are actually not dangerous to aeroplanes. And in the past 40 years, there have not been any air disasters that are caused by air turbulence. So just like how safe air travels on well-built and well-serviced commercial airplanes are, our empirically supported and globally diversified portfolios have actually a very high certainty of delivering returns for our clients over the long term. But we do need to remind clients the air safety procedures, such as stay seated, with the seat belts fastened, and when turbulence happens, we need to be there to provide the information. We need to be there to assure and calm, such that they can all reach their desired destination in due time. So what we did for TMP is that we further enhanced our discussions with our clients before they actually start investing, such as showing them the possible range of returns that their portfolios can undergo, that it can actually have a negative 20% in a year, as an example. But we also show them from historical data that after 10 years, barring the Great Depression, globally diversified portfolios generate good returns, even if they invest right before a major market crash. And this education and coaching permeates through our advisory process and our regular reviews with our clients. And the yearly mobilization exercises are also now part and parcel of our training calendars.
Right, so this enhancement is really to formalize it within our advisory process. And now it starts right from the beginning of a client's investment journey, rather than when a crisis hits.
Yes.
Okay, so before we end, it will be a crime for me to not ask you to share with us stories from past crises, especially with your vast experience. So could you share with our listeners stories from past crises whereby prudent wealth management, hand-holding, and risk coaching proved to be so important?
Certainly. Well, this happened during the COVID-19 crisis. I have a couple who have just retired the year before. So when the markets came down, we activated our CMP. And they were one of the first few clients that I actually called. Their concern was, should they sell out their investments to preserve their capital, given that they have stopped work and they are really relying on these monies, right, to sustain them for the rest of their lives. So these are actually very, very real concerns that I acknowledged. I then took time to remind them of the Retire Well plan that we did for them. I assured them that for their immediate 5 years of cash needs, they are actually very, the monies are parked in very safe instruments such as bank deposits and their CPF accounts. And what they need for the subsequent years of year 6 to year 10 are actually in a conservative portfolio, where the fall in the portfolio value is relatively lower due to a bigger allocation to short-term fixed income funds. So even if this market crisis were to be a very prolonged one, their cash needs are secured, it's not affected. And for their other investment portfolios, they only need the monies in more than 10 years' time. And stock market history, right, has shown us that stocks will give positive returns if you have more than 10 to 15 years of time frame. So this helped them to recall the risk coaching discussions we had before they started investing their monies, and where we actually showed them the range of returns for the various portfolios, and how even if you invest just before market crash in oil crisis in 1973, internet bubble in year 2000, and of course GFC in 2008, after 10 years you will get a positive annualized return. After all this, they were actually very comforted, they're very assured, and I'm thankful that they stay invested. And right now, they are sitting on positive returns on all their investments with us. And I must add, they are enjoying their desired retirement lifestyle.
Right, thanks for sharing, Evelyn. It's always very heartening to hear stories about how we made positive impacts to our clients' lives. I also want to end off by saying thank you so much for over 2 decades of your work, helping to create this platform for like-minded people like myself to carry on the good works that you and the founding team have done.
Yeah, but we are very blessed to have you on board with us as well.
That's all for this week's episode. Thank you for your time today, Evelyn.
Thank you for having me.
To all our listeners, I hope you enjoyed our episode on resilience through financial crises. If you like this episode, follow our podcast and follow us on social media for similar contents. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.